As trade tensions between the US and China escalate, imagine waking up to breaking news. China has dumped all its US Treasury bonds. You know what will happen next. Global markets in turmoil, stock prices dropping rapidly, and fear spreading like wildfire. But could this really happen? And most importantly, what impact would it have on you, the US, and the world economy? Let's dive in.
If China owns 800 billion of US debt, which they do, then of course the United States, as the borrower, has to pay interest, which means that you and I and everybody else gets to pay taxes every year.
The US exported $143 billion worth of goods to China in 2024 alone, yet still had a significant trade deficit of $295 billion. The escalating trade war between China and the United States is being driven by rising tariffs, economic friction, and growing political tensions. In response to the ongoing trade tensions, President Donald Trump increased tariffs on Chinese imports to 145%. China retaliated by imposing 125% tariffs on American products. Although Trump announced a 90-day pause on tariffs for most countries, China was excluded from this relief, which further intensified the trade conflict between the two nations. China's Ministry of Commerce fired back by announcing its readiness to fight the trade war to the end, accusing the US of violating World Trade Organization rules. At the center of the trade battle is a tangled financial connection between the countries. One key issue is that China holds a significant amount of US debt and may use it as a bargaining tool in the tariff dispute. What does this mean? The US raises money by selling treasury bonds, which are like IOUs that pay interest. Investors, including those from other countries, purchase these bonds to lend money to the US government. China owns about $760 billion worth of them, second to Japan's $1 trillion. If China were to dump US bonds, it could drive down their value and push up the interest rates in the United States.
When you dump bonds, yields shoot up. It will raise the cost of funding for US government.
This would make it more expensive for the US government to borrow money and could erode investors' confidence. However, this move could also hurt China, since selling so many bonds at once would lower their value and reduce the return on its investments. Before we proceed further, you might be wondering, why would China buy so much of US debt? Holding foreign debt is a common practice among countries actively engaged in global trade, and China is no exception. Its reasons for buying US debt are similar to those of many other nations, but two key historical events help explain why China in particular built up such large holdings. The first was the 1997 Asian financial crisis, which exposed the vulnerabilities of economies with low foreign reserves. In response, countries like China began accumulating foreign currency reserves as a financial buffer. Much of these reserves were parked in US Treasury bonds because they are considered safe, stable, and easy to sell if needed. This strategy helped several Asian economies, including China, bounce back more quickly after the 2008 global financial crisis. For China, holding US debt serves multiple strategic goals. US Treasury bonds are considered one of the safest investments globally, and since the US dollar is the world's reserve currency, these bonds can be sold quickly in times of need. They form a critical part of China's financial safety net, helping it weather global shocks and manage short-term debt. By exporting more than it imports, China has built up massive amounts of foreign currency, especially US dollars. Instead of letting that cash sit idle, the Chinese government invests a large share of it in US debt. This not only keeps their reserves productive, but also helps manage the flow of money into the country, preventing their domestic economy from overheating. By buying large amounts of US debt, China can influence the value of its currency, the yuan. Keeping the yuan weaker against the dollar makes Chinese exports cheaper and more competitive abroad. Of course, with China holding such a large share of US debt, there are growing concerns that it might one day use this as leverage, especially during times of political or economic conflict, such as the ongoing US-China tariff war. Some economists, such as Alex Jaquez from the Groundwork Collaborative, have warned that if China were to suddenly sell a significant portion of its US bonds, it could trigger major disruptions. bond prices could plunge, interest rates could spike, and global markets might react with panic. A move that could hurt one and hurt all. Have you thought of this? What if China suddenly decides to sell all of its US Treasury bonds? It seemed like an unlikely move due to its potential impact on China's economy. The thought of this only highlights how interwoven the global financial system is, and just how badly it can go when major players make significant moves. Historically, nations have held gold and foreign currencies as safe reserves. After World War II, many countries accumulated large holdings of British pounds, not to spend or invest in the UK, but simply as a store of value. When these reserves were eventually offloaded, the sudden oversupply triggered a currency crisis in Britain, driving up interest rates and damaging the economy. Could the US face a similar fate if China were to offload its US debt holdings? China owns $760 billion in US debt. If it were to sell a larger part of that suddenly, the market would be flooded with US Treasury bonds. That oversupply would push bond prices down and cause interest rates to rise as prices and yields move in opposite directions. This kind of shakeup would hit the US hard, but the impact would be felt around the world. Let's start with the immediate impact on the US. If China were to suddenly dump its US bonds, it would shake even the robust US Treasury market. Although the US Treasury market is vast and easily tradable, it would be severely impacted by such a significant action. Right away, the market for bonds would be a mess. Their prices would drop significantly, and their yields would skyrocket, making it much more expensive to borrow money. The US government would have to pay significantly higher interest rates to attract lenders in the future. This would make it more difficult for the government to fund essential services, such as roads, schools, and the military. Things like home loans, car loans, and business loans would all cost a lot more. The people will, however, borrow but spend less, which will slow down the economy. The US government, which borrows extensively to fund its operations, would be severely impacted. Even a 1% rise in interest rates on the country's $30 trillion debt could result in an additional $300 billion per year in interest payments. That would make managing the national debt even tougher and raise serious concerns about the country's financial health. How about a potential crisis in the housing market? The housing market would likely be one of the first sectors to be impacted by a crisis. Higher mortgage rates would make it harder for people to afford homes, resulting in fewer homes being sold. Prices could drop and more people might lose their homes, a resemblance to what happened in 2008. As interest rates rise across the board, people will spend less. That means lower demand for products and services, and businesses might pull back on hiring or investing. Imagine that China's actions severely disrupt the US Treasury market. It could trigger major changes in how the world conducts business. The impact wouldn't just stay within US borders. It would have a ripple effect across the globe. If investors lose confidence in US Treasury bonds, a key pillar of the global financial system, it could shake markets worldwide. Stock markets would likely take a hit. Investors might panic and begin selling off their assets. And automated computer trading systems could exacerbate the chaos, causing rapid declines in stocks, commodities, and currencies. Emerging economies would be especially vulnerable. As investors rush to withdraw their money in search of safer assets, the value of local currencies could decline. Countries heavily dependent on trade with the US would also suffer, as demand for their exports drops. Economies in Europe, Asia, and Latin America could experience significant slowdowns. If the dollar devalues, countries may attempt to reduce their reliance on it in trade or even devalue their currencies to remain competitive. This shift could accelerate the move away from the US dollar and toward alternatives, such as the euro or China's yuan, thereby weakening the dollar's dominance in global trade. Meanwhile, international institutions like the IMF and World Bank could become overwhelmed by countries in crisis seeking assistance. That would likely spark serious debates about how to restore stability and how to prevent a similar global crisis in the future. But the question is, would China go that far? Probably not. Selling a large amount of US debt would hurt China's economy. It would reduce the value of the US bonds it still holds. Dumping these assets would crash bond prices and shrink the value of China's dollar-based investments, much like burning your savings. China also depends on the US debt to help manage its currency. Selling those bonds would strengthen the yuan, which would make Chinese exports more expensive and less attractive to buyers worldwide. Since China's economy heavily relies on exports, that's a risk it can't take. A stronger yuan goes against China's usual strategy of keeping its currency weaker to stay competitive. Furthermore, if the US economy weakens, it could have a negative impact on the global economy, which China also relies on. Slower global growth would reduce demand for Chinese products, hitting its exports even harder. There's also the issue of reputation. A drastic move, such as dumping US bonds, could harm China's image as a responsible global player. Plus, there's no other market as large, stable, or easy to trade in as US Treasuries, so finding a good alternative would be difficult. Overall, it would be a lose-lose situation. That is why, instead of a sudden dump, China has been slowly reducing its holdings by letting bonds expire without buying new ones. This quiet strategy avoids alarming markets and gives China more room to maneuver. Even with tensions rising, most experts agree that a big sell-off is still unlikely. With about $3 trillion in dollar-linked assets across its government and banks, China has every reason to keep the dollar and the US economy stable. That said, even if China did sell, the impact on the US might be limited. Since US debt is in high demand globally, other countries could buy what China sells. For example, in 2015, China sold about $180 billion in US bonds, and the effect on the US economy was minimal. While a big sell-off by choice is unlikely, certain situations could force China to sell part of its US debt holdings. Rising tensions, such as those over Taiwan or the ongoing tariff war, could push it in that direction. Another reason might be the desire to spread out its investments by buying gold or other non-dollar assets. A serious crisis inside China could also lead to selling if the country needs cash to stabilize its economy. Alternatively, if confidence in the US economy or the dollar declines, China may reduce its dollar investments. Even in these cases, sales would likely occur at a slow pace. China would want to avoid shaking the markets and hurting its economy. But what if the unthinkable happens? If China decides to sell a large amount of US bonds, what could the US do? Can it stop the sale? Technically, no. US Treasuries are traded on open markets, allowing China to freely sell them. But the US government and the Federal Reserve would likely act fast. The Fed could step in to buy bonds and keep interest rates from spiking. It might also use tools like quantitative easing, printing money to buy bonds, or reduce interest rates to make borrowing cheaper, similar to what it did during the COVID-19 crisis. Still, these actions depend on broader policies. For example, recent signs indicate that the Fed may hold off on cutting rates for now, and some banks, such as Morgan Stanley, expect no rate cuts this year. On the government side, officials could slow down the issuing of new bonds and introduce stimulus programs to keep the economy going. They might also hold diplomatic talks with China to reduce tension and calm the markets. Over time, the US could try to avoid relying too heavily on any single country by spreading out its debt. Even with these steps, a large sell-off would likely shake the markets and hurt the global economy, at least in the short term. It is highly unlikely that China would suddenly sell all its US debt. It would harm its finances. However, even the idea of it reveals how closely interconnected the global financial system is. One major decision by a big economy can send shockwaves around the world. To manage these risks, leaders must remain vigilant, foster more diverse economic relationships, and enhance global cooperation. In today's world, where political tensions are rising, our financial ties are both a strength and a potential weakness. Do you think China will sell off its US Treasury bonds to gain an advantage in the ongoing tariff war? Let us know your thoughts in the comments.